So for this session, our academic moderator is Allison Nicoletti from the University of Pennsylvania. So I'm going to turn it over to her. She's going to introduce the session, and then we will go through our three papers. I believe hear from our community bank discussant, or are you going to switch it? Switch it around. We're going to hear from Allison, and then we'll hear from Luann Cundiff, our community bank discussant. Allison, all yours.
Okay, great. Well, thank you so much, Jim. So Mike is good. Okay, great. So I want to thank, of course, Jim and everyone that was involved in organizing the conference. This has been great, and I'm so honored to be the moderator of this session. I feel like we have a great team up here. So Alan, I know you said yesterday's second session was the best one you've seen in years, but I think we're going to give you a run for your money on this one is the plan. So we're going to go basically in order. So each of the papers is we'll go basically Amy, Oktay, and then Cindy, and then I'll offer some high-level comments, and then I'll turn things over to Luann. So with that, I'd like to turn it over to Amy Hutton, who's going to talk to us about regulatory transparency using a really interesting setting of SEC comment letter correspondence. So Amy, the floor is yours, and you have 15 minutes.
Great, thank you. Okay, hi everyone. I hope you can hear me okay. Yeah, okay, good. So thank you so much to the organizers of the conference. We're delighted to be here to share our research with you. One of my co-authors is in the back of the room. Singh is here. The others aren't here today, but they're here in spirit, and they certainly worked very hard on this paper like all of us did. So what we're doing in this paper, let me see if I can figure out how to make this work. The green button, of course, the green button. There we go. Okay, so what we're doing in this paper is we're using a change that the SEC made around the public disclosure of its comment letters in 2004 to take this as a moment in time when we can say, okay, there's been a change in the regulatory transparency from the SEC to the public. And we're going to ask the question, how has, oops, so we're a little further along than I wanted to be. Back there. Okay. How has this change in the regulatory transparency, how has it impacted the way that public banks think about their financial reporting and their lending decisions? Okay, so one of the things I am learning, I heard Clayton talking about, is you're all mostly running private banks, but these analogies, I think, can still be made from what happens to what the public banks are going to do to what may happen if regulatory transparency were to become enhanced in the private setting as well. So in this public setting, what happens in particular is that in 2004, SEC decided to start to make its public, the comment letters that it writes to registrants, to public banks. So prior to 2004, these comment letters existed. They just were hard to get your hands on. In order to actually get hold of a comment letter prior to 2004, you had to file a Freedom of Information Act request. And the SEC realized that what was happening is that there were some providers of data who were clever and were figuring out that if they filed a bunch of Freedom of Information Act requests, they could find a way to get this data and then sell it. So in 2004, the SEC decided it's not what we want. One of our objectives as a regulator is to create fair and markets where everyone has access to the information at the same time. So their stated objective was to change the policy to alleviate delays in access and to ensure that there was not a selective nature to the access to these comment letters. Now, the important thing, too, is what's in these comment letters. And the public banks who receive these comment letters, what's in them is a discussion about the quality of their loan loss provisions and their reserves. That's the most common topic. And the way the comment letter process works is a public bank will receive a comment letter from the SEC, and then they will start to correspond with the SEC, explaining how they're going to resolve the issues the SEC has with their financial reporting and with the way that they're doing things. Well, what the SEC did in 2004 is it said, we're going to wait till the review is over, excuse me, and all of the decisions and all of the fixes have been put into place, and then we're going to take the entire correspondence and we're going to start to put it up on EDGAR and make it available to the public, right? So that's a pretty big change from what they were doing before. So what we do in our paper is we use this, what we're going to call a difference in difference setting, because we've got a time series change between the pre and the post 2004 for the comment letters, and we've got the private banks versus the public banks to look at the cross-sectional setting. And that's going to allow us to design research that is going to control for both time series changes that are confounding to the inferences we want to make, as well as cross-sectional changes that could be confounding to the inferences that we want to make. So in order to kind of set up the understanding of why we're going to study this and what we hope to be able to speak to, I want to lay a little bit of foundation on the theory. So there is, in economics, some strong theory about what the impact of regulatory transparency could be on our banking system. There's really a bright side and a dark side to transparency, or the pros and the cons. And these arguments are both really well laid out in the economic theories, and they both make perfect sense that there would be effects coming from the pros and the cons. What we're going to do in our paper is try and see if there's evidence of each of these sides to the stories. We know there's going to be duality to what the effect is going to be. So let me give you a little bit of sense of the bright side. The economists who argue for the bright side highlight that with greater regulatory transparency, you get enhanced monitoring by the public. The public becomes informed about what banks are doing, the riskiness of individual banks in comparison, and it allows then the public to do a better job in efficiently pricing the capital to the banks. Now remember, these are public banks. And when the banks are, given the banks are going to be aware of the fact that there's going to be more transparency, that's going to feed back to a change in their behavior, and they should then take on less risk, and they should be looking to improve the quality of their reporting in that less risk piece. The other thing that will happen when you get more monitoring by the public is the other bank regulators, many of those that are in the room, will be aware of the fact that the public's now aware of what the SEC is saying. And so being aware of that, the other bank regulators would probably, the expectation is that they would exhibit less forbearance on the banks, that they would be more proactive and more forward with the banks. So the idea here is that there would be what we're terming in the paper regulatory spillover, that the regulatory transparency from the SEC would translate into more action by other regulators. Primarily what we're thinking of is action where they take early action and try to eliminate issues that the SEC is starting to point to. The dark side of transparency, or the pros, I think you can imagine, is that when the public becomes aware of differences in risks across banks, that could discourage risk sharing among the banks and other capital providers for banks, right? That in the repo market, there's going to be less liquidity available to the riskier banks if they're known to be riskier. And then at the deposit market, the funding costs for those banks will go up. Now, one challenge we face in this academic setting is we don't have data on repo markets. We would love data on the repo rates. We don't know how to get that. If anybody here knows how to get that, please let me know, because I would love to have that data. We don't have it. So what we've got is data on depositors' rates. The other thing that could happen, of course, is if this went to an extreme, would be that they would have a reduced access to credit, and of course you would potentially have instability, and that could lead to bank runs. And this is why the academics argue in their theories, and they do a good job of explaining how really you need your outside credit providers to be somewhat, they call it informationally insensitive, that they don't actually know a great deal about the bank, that too much knowledge is not a good thing because of where it could lead, right? Okay, so what we do then is we take these theories and we say, okay, if the SEC's move to making its comment letters public actually enhanced regulatory transparency, then for the public banks, then what do we expect to see the public banks doing in response? And we argue that the public banks will change their financial reporting, in particular to ward off the unwanted scrutiny that would come from their depositors and that might come from this regulatory spillover. They would then take on a more conservative approach to their financial reporting. And specifically, we look at whether they improve the timeliness of their loan loss provisions. And remember, we're using this difference in difference approach. So we're using this controlling for time series as well as cross-sectional. So we're going to compare from pre to post how public banks' behaviors are changing relative to private banks. And we have a fancy regression in the paper, but it's not a lot of fun to look at if you don't like looking at a lot of coefficients, and we've got a lot of fixed effects and other things in there. So I tried to simplify it into a picture to give you a sense of what's going on. And what you see is that as we move from the pre-period, which is the gold blocks, to the post-period, which is the blue box, the public banks move to, compared to the private banks, move to more timely recognition of their loan loss provisions. Okay, and then the second thing, so that tells you a little bit about how they changed their financial reporting. The second thing we're interested in is how their lending behaviors change. First, we postulate that with the Hirschleifer effect, this bad story of it would discourage risk sharing among the depositors and among banks, that would hurt the bank's liability side of their balance sheet and ultimately affect their funding costs that would increase, and it could reduce their capacity to make new loans, and it could actually cause greater procyclicality in their lending activities. So we're going to examine all of that on the negative side. On the plus side, if there's a plus side to enhanced transparency, it would be that these banks would start to move towards less risky borrowers, right? So these are the things we're going to look at, and again, I've tried to make the pictures instead of making you look at regressions. And the picture to focus on really here is these green bars over here where we're comparing what happened. When you move from the pre to the post period, interest rates are declining, right? This is loan growth. So what happens as you move from the pre to the post period is that the public bank's lending activity is declining by more. So this is the decline in the loan growth, and the green bar shows that their loan growth declines by more than the private banks. So it does seem that this transparency is having a tightening effect on their capital availability. The second thing that we look at is the procyclicality of their lending. So this is the idea that the lending growth, the loan growth, will be a function in part of GDP, right? And if we, as people who care about the banking system and who care about getting out of recessions more quickly, procyclicality is not a great thing, right? We want to see lending even in downturns. But as we move from the pre to the post period, what we see is that for public banks, they become more, their lending activities becomes more procyclical. So that kink in the relationship is higher for the public banks. So it appears that as you move to with greater transparency, you actually cause these banks' lending activities to be more a function of GDP growth, which is not what I think we want. The last piece is the borrower risk. So this is the good news story, that as you move from less transparency to more transparencies, the public banks are becoming more conservative. They're lending to lower risk borrowers. Now, the last two tests that we provide in our paper are really part to validate the underlying assumptions that we make, or that are necessary for us to make to postulate what we do. And the underlying assumptions are that the public banks are anticipating the greater scrutiny, and because of that, they're changing their behavior. So if there is truly greater scrutiny, we should see, when we compare public banks who get and do not get comment letters, an increase in their funding costs and more activity from other regulators. And so those are the next two things that we examine. In this part of the paper, we don't look at private banks anymore. We're just looking at public banks. And we're comparing them, again, in a difference in difference design, pre and post. And we're comparing, though, now those who did and did not get comment letters from the SEC. And what we find is that, in fact, this is what I was thinking of earlier. The deposit rates are falling from the pre to the post period, but the decline for the banks who receive comment letters, the green bar over there, is smaller. So effectively, their funding costs increases from the pre to the post period. Secondly, we look at EDOs that are issued to these banks, and we find that there's a large increase in EDOs issued to banks in the post period who receive comment letters, and it's much larger than the increase that those who did not. We also recently looked at whether banks that are politically connected might escape this regulatory spillover, and we find that's not the case. So politically connected here is banks who give money to PAC organizations, who donate to political organizations. And what we find is that they, the other regulators, still give EDOs, issue EDOs to these banks. We do a bunch of robustness checks to make sure that if we change the sample or we change the time period, our results don't change. That's for all the academics who might be skeptical of our results. And then the big thing is what we do here is we demonstrate empirically that there is a trade-off between these two theoretical effects of increased regulatory transparency. When you have greater market discipline, you get some benefits, but when you have reduced risk sharing, you also get some costs. And we think that this is important because there's not been a lot of opportunities to provide empirical evidence of the theory. So that's what we do. Thank you very much. Thanks, Al.